All right, so you ready to like really get into value investing? Because we keep seeing Gone Fishing with Buffett everywhere in your notes. And like
Yeah.
there's a reason for that, right?
Right.
It's kind of this like like friendly intro to the whole world. It's like having, a seasoned investor just kind of there with you on a fishing trip, just ready to spill the beans on how to succeed?
Well, it's interesting, right? Like the author really framed the book as a story,
Hmm.
which makes it super accessible even if you're totally new to investing.
Yeah.
But the part that I find most interesting is that they really built all this knowledge from their own mistakes, like,
Mm.
real life messing up.
Yeah.
And it comes across as this like raw and honest perspective.
I love how they kick things off with this rule that's so important. They say it twice. Investment rule #1, never lose money. And rule #2, never forget rule #1.
Right.
Seems pretty obvious at first, but how does the book actually build on that?
Well, they go way deeper than just, saying the obvious.
Yeah.
They actually break down the math behind why losing money is just so bad for your long-term success. It's not just about getting back to where you started. It's the growth you miss out on during that time.
Makes total sense. Can you give us an example? Like, how would that actually play out?
Totally. So imagine you start with $100 and you lose 50%. You're down to $50, right?
All right.
Now, to get back to that original $100,
Yeah.
you don't need a 50% gain. You need a 100% gain.
Wow.
That's compounding working against you. And what the book really emphasizes is that by minimizing those losses, you're setting yourself up for way better compounded returns in the long run.
That's a really cool way to think about it. And the book doesn't stop there. It actually encourages us to like change how we see stocks, to see them as businesses, not just these tickers on a screen.
Yeah, for sure. It challenges that idea that stocks are just pieces of paper to be traded.
Yeah.
They use a great analogy. It's like buying a car or a house. You wouldn't do that without understanding the value, right?
Of course not.
So why treat stocks any differently?
It seems so obvious when you put it like that. And this kind of ties into Warren Buffett's whole approach, right? Buying those undervalued businesses, focusing on things like book value to figure out their real worth.
Exactly. Book value isn't the only thing we use today, but it really highlights the importance of looking past just the stock price and really understanding what a company is worth before you invest.
The book also uses this really cool analogy to explain competitive advantage. They call it the fishing net.
Oh, yeah.
Can you tell us about that?
Yeah, so it really helps you visualize how some businesses are just set up to succeed consistently. A fishing net compared to just like a single fishing rod
Right.
represents a company's ability to attract and keep customers no matter what the market's doing.
That's such a great image. And the book goes even further, giving us this 5-question checklist to help us identify these fishing net businesses, these companies, with a durable competitive advantage.
Totally.
I found that super helpful. What's the first question on that list?
Okay, so the first one is, what value, what products or services does this business offer? Like, can we actually explain that clearly?
Right. It forces you to really understand what the business is giving to its customers.
Yeah.
Then question 2 gets into the competition. Is this value provided by anyone else? If the answer is no, well, maybe we've got a monopoly on our hands.
Right. But if it's a yes, then we need to go deeper with question 3.
Okay.
This one focuses on us as consumers. Would I personally choose to get this value from somewhere else?
And if the answer is yes, then this business might not have that special something that makes it stand out.
That's it. It's not just about whether competitors exist. It's about whether they can actually make us want to switch.
And that leads perfectly to question 4. Why would we rather get this value from this business instead of from anywhere else? This is where we start to uncover those fishing nets, those
Yeah.
things that make customers choose one business over another.
The book uses KFC as a great example.
Yeah.
So even though there are tons of fast food options out there, KFC has that unique thing going on with their secret recipe and that smell right.
Yeah.
They've created this strong fishing net that keeps people coming back.
That's a perfect example, and it sets us up for that 5th and final question. Is this reason sustainable in the long run? We don't want those businesses that are just trendy for a bit. We want the ones that are built to last.
Exactly. It's about that lasting power.
Now, once we've spotted these potential fishing net businesses, where do we go from there?
Now, Gone Fishing with Buffett gives us some solid advice on where to look for these great businesses. They say stick to your circle of competence, meaning, focus on industries and businesses you actually get.
Right.
It's all about knowing what you know.
Yeah.
You don't need to be an expert in everything, just the areas where you have real insight.
The book also encourages us to look at our own lives for clues like where do we spend our money and where do we earn it?
Yeah.
Those industries might actually have some hidden gems that we just understand better than most people.
It's like finding opportunities right under our noses. But even within our circle of competence, how do we know if a company is actually worth investing in?
Well, that's where analyzing a business's track record comes in. Gone Fishing with Buffett is all about consistency, especially when it comes to profits and returns.
For sure. It's about those companies that deliver year after year, not the ones that are all over the place.
Right.
We want to see steady growth.
And the book uses this really fun analogy to illustrate this: Wendy and Harold businesses. Basically, Wendy businesses, like the restaurant chain, are those steady performers.
Yeah.
Harold businesses, on the other hand, are like that unpredictable friend who's either super happy or super down.
That's a good one.
So we definitely want more Wendy businesses in our portfolio, right?
Yeah. And one of the best ways to figure out a business's consistency is to check out their historical earnings per share, or EPS.
It's like looking at a company's report card. Are they getting straight A's or are they barely passing?
Exactly. The book uses Ford Motors as an example of what to avoid. Their EPS history is full of ups and downs. Some years they're profitable, some years they're not.
Not exactly the steady performer we're looking for. So we're looking for consistency in earnings, but what other financial things should we be looking at?
So two big ones the book talks about are return on equity, ROE, and return on assets, ROA.
Okay.
These are super important for figuring out how efficient a business is.
Can you break those down a little more for us?
Sure. So ROE tells us how well a company is using money from shareholders to make profits. It's like measuring how well they're putting your investment to work.
And ROE gives us a broader view of how efficiently the company is using all its assets, not just the money from shareholders.
Right. We want to see both ROE and ROA consistently high.
Yeah.
And this is where it gets interesting. If a company has high ROE but low ROA, that could be a red flag.
What does that tell us?
It could mean they're relying too much on debt to boost their returns, which could be risky, especially if the economy takes a downturn.
That makes sense. And speaking of debt, Gone Fishing with Buffett has this great analogy to explain how it can be bad.
Yeah.
They compare debt to a talented violinist who can't get any gigs during a recession.
Good one, right?
It shows how debt can be good for growth, but also really dangerous if it's not managed well.
Totally. So how do we know if a company is handling their debt well?
Well, one important thing to look at is the interest coverage ratio. This tells us how easily a company can cover its interest payments on its debts. We want to see a good cushion, like a ratio of at least 3.
So that means they could handle their interest payments for 3 years even if their earnings took a hit.
Exactly. It's like a safety net for the business.
Okay.
Okay, so aside from financial health, what other things should we look for in a great business?
Gone Fishing with Buffett dedicates a whole section to pricing power. Can a business raise prices without losing customers? If they can, that's a great sign they have a strong moat.
It's like a test for a company's fishing net. Think about the brands you're willing to pay more for, even when there are cheaper options.
Totally.
They've figured out how to create real value that people are happy to pay for.
Exactly. And then there's the whole people factor, which I found really interesting.
Yeah.
It's not about finding a superstar CEO or anything like that. It's about finding those businesses that are well-structured and can thrive no matter who's in charge.
Right. The book has this great quote: "Buy businesses that even a fool can run, because someday a fool will."
That's a good one.
Harsh but true. We want businesses that have good systems in place so they can keep doing well even if management changes.
It's about finding companies that aren't completely dependent on one person, even if that person seems amazing.
So we've talked about analyzing businesses and their finances, but what about the market itself? How does Gone Fishing with Buffett deal with that?
That's where Mr. Market comes in. One of the most fascinating parts of the book.
Yeah, it's so clever.
It's like this personification of how irrational the stock market can be.
It really captures that unpredictable and emotional side of the market.
Mr. Market is this character who shows up every day offering to buy or sell you pieces of businesses. Right.
Some days he's super optimistic, other days he's totally down.
And the key is that we as investors need to stay level-headed and not get caught up in his mood swings.
It's like having a business partner who's constantly changing their mind. You got to learn how to work with them without letting their emotions mess with your judgment.
Exactly. And the book uses IBM as a real example of how Mr. Market can misprice even the best businesses.
Okay.
So IBM had consistent earnings growth for 10 years, but their stock price was all over the place, sometimes completely out of touch with how the company was actually doing.
That's Mr. Market. in a nutshell.
Yeah.
Not always the most rational guy. So how do we deal with Mr. Market and figure out a fair price for a business?
Gone Fishing with Buffett gives us this 5-step process for finding your target buy price.
Okay.
It helps you find a price that works for you based on how much return you want to get.
That's so important. It's not about trying to time the market or guess what prices will do in the short term. It's about finding businesses that are worth owning at the right price for you. I imagine this 5-step process is pretty detailed. Can you give us the simplified version?
Absolutely. So you start by calculating how much a company's earnings per share has grown each year over the past 10 years. Then you use that growth rate to predict what their EPS will be 10 years from now.
So basically, we're looking at the past to make an educated guess about the future.
Yeah, exactly. We can use financial calculators or online tools to help us with these projections. It's all about understanding how those earnings could grow over time.
Okay, so we've got an estimated EPS for 10 years from now. What's next?
Then we need to estimate the stock price 10 years from now. To do that, we use something called the price-to-earnings ratio, or PE ratio.
Okay, I've heard of the PE ratio, but can you explain it simply? What does a high PE ratio versus a low PE ratio actually tell us?
So a high PE ratio usually means investors are feeling good about a company's future growth. They're willing to pay more for each dollar of earnings because they think those earnings will go way up.
So a high PE ratio means confidence, and a low PE ratio means maybe some doubt about the future.
Exactly. We can find historical PE ratios for companies online pretty easily. Let's say Coca-Cola's average PE ratio over the past 10 years has been 19. To estimate their future stock price, we just multiply our projected EPS by that historical PE ratio.
So we're basically guessing the future stock price based on how much the company could earn and how much people have historically paid for those earnings.
Yeah. Now here's the really cool part. Step 4 is where you figure out your target buy price based on how much return you want to get. This is where it gets personal.
This is where we tailor it to our own financial goals, right?
Yeah.
What if we want a 20% return each year? How does that fit into the calculation?
Good question. So we would take our estimated stock price for 10 years from now, and we figure out what price we need to buy it at today to get that 20% return each year for the next decade.
So we're working backward from our goal to figure out the right time to buy. Sounds like we need a financial calculator or something.
Yeah, exactly. And what's great about this approach is that it makes sure our investments match up with our own financial goals. No more guessing games, just informed choices.
This is making a lot of sense. Now, remember, there was a 5th step to this process. What was that again?
Ah, yes. Step 5 is all about adding a margin of safety. This is super important in value investing. It's about accepting that we can't predict the future perfectly.
It's like that extra cushion we talked about, just in case things don't go exactly as planned.
Exactly. We need to remember that our calculations are based on the past and on predictions about the future, which can be tricky. The margin of safety helps us deal with that uncertainty and be a little more careful.
So how much margin of safety should we use? Is there a magic percentage?
The book suggests about 15%, meaning we'd lower our target buy price by 15%. But it's not a hard rule. It depends on how much risk you're comfortable with and the company you're looking at.
So if our original target buy price for Coca-Cola was, let's say, $35.44 with a 15% margin of safety, we'd adjust that down to about $30.12.
Exactly. By buying at that lower price, we're giving ourselves some wiggle room just in case we were a little off or something unexpected happens in the market.
This makes a lot of sense. It's all about minimizing risk while still setting ourselves up for potential gains.
That's it. The margin of safety is a powerful tool for value investors. It helps us make smarter and more calculated decisions. It's about knowing that we can't know the future for sure, but we can take steps to protect ourselves.
Now, I get that this 5-step process is just one way to figure out a target buy price.
Right.
There are other ways to value businesses.
Oh, yeah, totally.
Yeah.
There are lots of different ideas out there about how to value a business. But this 5-step process gives you a solid way to start thinking like a business owner and making smarter investment decisions.
It's about looking past the stock ticker and seeing the company as a real thing with its own story, its own finances, and its own potential to grow in the future.
Exactly. It's about understanding the basics of the business and making choices based on facts and analysis.
Yeah.
Not just your gut feeling or what everyone else is doing.
Now, we want to buy companies at a good price, but we also need to know when to sell.
Right.
Gone Fishing with Buffett has some interesting thoughts on that, too. Can you remind us what those were?
Yeah, for sure. The book makes it clear that selling isn't about trying to outsmart the market or guess what prices will do in the short term.
Right.
It's about making strategic choices based on how the company's doing and what your own financial goals are.
So it's not about chasing quick wins or trying to be smarter than everyone else?
Nope. The book says there are three main reasons to sell. The first is when the stock price hits your target return.
Okay.
So if you bought a stock at a price that made sense and it's gone up enough that you've hit your goal, it might be time to think about taking some profit.
So it's about having discipline and sticking to your plan.
Exactly. It's easy to get excited when a stock is doing well and just hold on hoping for even more. But the market can change quickly, and what goes up can come down.
Makes sense. What's the second reason to sell?
Sometimes you might find an even better opportunity,
No.
something that looks even more promising than what you're already holding. In that case, it might be smart to sell some of your current investments to free up money for this new exciting thing.
So it's not just about keeping the winners, it's about being open to new possibilities that might be even better.
Exactly. But the book warns against becoming a frequent trader, always jumping from one stock to another, trying to make quick money. Remember, patience is key in value investing. We're not looking for quick wins. We're looking for long-term growth.
So it's about finding those great businesses and letting them do their thing over time.
Exactly. Now, the third reason to sell is if the business you invested in isn't so great anymore, maybe because things have changed or their competitive advantage isn't as strong.
So if the company's not doing as well or it's not the same fishing net business it used to be, it might be time to rethink our investment.
Exactly. It's important to keep up with the businesses we own and be ready to change our strategy if we need to. That's one of the main takeaways from Gone Fishing with Buffett. Value investing isn't about following a set of rules. It's about learning, adapting, and making smart choices as the business world changes.
That's a great point. It's not about blindly following rules. It's about really understanding the ideas behind value investing and using them in a smart and flexible way.
You got it. Value investing is as much an art as it is a science. It takes both analytical skills and a good understanding of how the business world works.
Speaking of nuance, I'm curious about that part in the book that talked about the difference between being rich and being successful. It was a little off topic, but it really made me think.
Yeah, that part really stuck with me too. It's easy to think that being financially successful is the most important thing. But Gone Fishing with Buffett reminds us that there's so much more to life than money.
It's about making sure our financial goals match up with our values and living a life that feels meaningful and fulfilling.
Exactly. It's about figuring out what success means to you and not letting things like money or status tell you what you're worth.
And I think that's a great message to remember as we navigate the world of investing and just life in general.
Absolutely. Real wealth is about living a life with purpose, meaning, and connection.
Well said. So that wraps up our deep dive into Gone Fishing with Buffett. We hope you've enjoyed it and learned some valuable things along the way.
Remember, the key to successful investing into a fulfilling life is making smart choices, staying true to yourself, and never forgetting the big picture.
Happy fishing, everyone. So that 5-step process for figuring out a target buy price. I got to know more about that. It sounded really interesting, but also kind of mathy. Can we break it down a little more?
Totally. Those calculations might seem scary at first, but they're actually pretty simple.
Yeah.
Remember, we're trying to think like business owners here, so we need to get those financial details.
Yeah, that's a good way to look at it. It's not just about plugging numbers into a formula. It's about understanding the business we're thinking about investing in. So what's the first step?
First, we got to figure out the company's earnings per share, or EPS growth rate over the past 10 years. This tells us how fast their earnings have been growing on average.
So we're looking for that consistent upward trend, right? We want to see that they've been making money and growing.
Exactly. And to get this growth rate, we can use a financial calculator or one of those online growth rate calculators. The book uses Coca-Cola as an example. So let's say we've got their EPS numbers for the last decade. We plug those in and boom, there's our growth rate.
Sounds pretty straightforward. So what do we do with that growth rate once we've got it?
That takes us to step 2, which is all about forecasting. We're going to use that growth rate to predict what Coca-Cola's EPS will be 10 years from now. It's like looking into a crystal ball, but with a bit more math involved.
So we're not just guessing, we're using real data to make a smart estimate about how much the company could earn in the future.
Right. We can use a financial calculator or an online compound interest calculator for this. It's all about using the power of compounding to see how their earnings might grow over time.
Got it. So now we have an estimated EPS for Coca-Cola 10 years down the road. What's next?
Step 3 is figuring out the stock price 10 years from now. For this, we need the price to earnings ratio, or PE ratio. This tells us how much investors are willing to pay for each dollar of the company's earnings.
Okay, I've heard of the PE ratio, but can you explain it? Like, I'm 5. What is a high PE ratio versus a low one? Tell us about a company.
A high PE ratio usually means investors are excited about a company's future growth. They're willing to pay more for each dollar of earnings because they think those earnings are going to skyrocket.
So high PE ratio equals confidence, low PE ratio equals maybe some doubts.
Exactly.
Hmm.
And finding historical PE ratios online is super easy.
Mhm.
Let's say Coca-Cola's average PE ratio over the last 10 years has been around 19. To guess their future stock price, we just multiply our projected EPS by that historical PE ratio.
Makes sense. So we're basically predicting the future stock price based on how much the company could earn and how much people have paid for those earnings in the past.
Yep. And now for the fun part. Step 4 is where we figure out your target buy price based on the return you want to get. This is where it gets personal.
This is where we tailor it to our own goals, right? Like, what if we want a 20% return each year? How does that work?
Great question. So we take our estimated stock price for 10 years from now and figure out what price we need to buy it at today to get that 20% return every year for a decade.
So it's like working backwards from our goal to find the perfect time to buy. Sounds like we might need a fancy calculator for this step.
You got it. And the best part is that this way our investment choices actually match our own financial goals. No more guesswork, just smart choices.
This is really starting to make sense. It's like we're taking charge of our money by understanding how these investment decisions actually work.
Exactly. We're not just following someone else's advice or going with our gut. We're using data and analysis to make choices that work for us.
Now, remember you said there's one more step to this whole process. What was that again?
Oh, right. Step 5 is adding a margin of safety. This is a big deal in value investing.
Yeah.
It's all about remembering that we can't predict the future perfectly.
Like that extra cushion we talked about, just in case we're not totally right.
Exactly.
Yeah.
We got to remember our calculations are based on the past and predictions about the future,
Mm.
which can be tricky. The margin of safety helps us deal with that and make safer choices.
So how much margin of safety is the right amount? Is there like a golden rule?
The book says about 15%, meaning we'd take 15% off our target buy price. But it's not a hard and fast rule. It depends on your risk tolerance and the company you're looking at.
So if we were looking at a company in a more up and down industry or one that's newer, we might want a bigger margin of safety, like 25% or even 30%.
Exactly. And if we're looking at a company that's been around forever and has a steady history of earnings, we might be okay with a smaller margin of safety, like 10% or 15%.
It's about finding that balance between getting the most out of our investment and protecting ourselves from losing money.
You got it. The margin of safety is like a superpower for value investors. It helps us make smarter and more careful decisions. It's about knowing we can't see the future, but we can do things to stay safe.
I'm with you. Now, this 5-step process is just one way to figure out a target buy price right. There are other ways to figure out how much a business is worth.
Oh yeah, there are tons of different ideas about how to value a business, but this 5-step process is a great way to start thinking like a business owner and making smarter investment choices.
It's about seeing the company as a real thing with a story, its own money situation, and its own potential for growth, not just some letters on a screen.
Exactly. It's about getting those business basics and making choices based on facts and analysis, not just your gut feeling or what everyone else is doing.
We want to buy companies at a good price, but we also need to know when to sell. I remember Gone Fishing with Buffett had some interesting thoughts on that too. Can you remind me what those were?
For sure. The book makes it clear that selling isn't about trying to time the market or outsmart everyone else.
Right.
It's about making strategic choices based on how the company's doing and what you want to achieve with your money.
So it's not about getting rich quick or trying to be smarter than everyone else?
Nope. The book says there are 3 main reasons to sell. The first is when the stock price hits your target return.
Okay.
So if you bought a stock at a price that made sense for you and it goes up enough to hit your goal, it might be time to take some profit.
So it's about sticking to your plan and being disciplined.
Exactly. It's easy to get excited when a stock is doing well and hold on, hoping for more. But remember, the market can be unpredictable. What goes up can come down.
That's true. What's the second reason to sell?
Sometimes you might find an even better opportunity,
Okay.
something that looks even more promising than what you're already holding. In that case, it might be smart to sell some of your current stuff to free up some money for this new, exciting investment.
So it's not just about holding on to the winners, it's about being open to new things that might be even better.
You got it. But the book warns against becoming a frequent trader, always jumping from one stock to another, trying to make a quick buck. Remember, Patience is key in value investing. We're not looking for quick wins, we're in it for the long haul.
So it's about finding those great businesses and letting them do their thing over time.
Exactly. Now, the third reason to sell is when the business you invested in isn't so great anymore. Maybe things have changed or their competitive advantage isn't what it used to be.
So if the company's not doing as well or it's not the same fishing net business it used to be, we might need to rethink things.
Exactly. We've got to keep up with the businesses we own and be ready to change our strategy if we need to. That's one of the big lessons from Gone Fishing with Buffett. Value investing isn't about following rules blindly. It's about learning, adapting, and making smart choices as the business world changes.
That's a great point. It's not about following rules. It's about understanding the ideas behind value investing and using them in a smart and flexible way.
You got to value investing is as much an art as it is a science. You need analytical skills and a good understanding of the business world.
Speaking of nuance, I'm really curious about that part in the book about the difference between being rich and being successful. It was a bit of a sidetrack, but it really made me think.
Yeah, that part really stuck with me too. It's easy to think that financial success is everything. But Gone Fishing with Buffett reminds us there's more to life than money.
It's about making sure our financial goals line up with our values and living a life that feels meaningful and fulfilling. Right.
Exactly. It's about deciding what success means to you and not letting things like money or status define you.
And I think that's a great thing to remember whether we're investing or just living our lives.
Totally. True wealth is about living a life with purpose, meaning, and connection.
I love that. And speaking of finding those hidden gems, Gone Fishing with Buffett talks about looking beyond the obvious and finding opportunities that other investors might miss.
Right. It's about thinking outside the box.
That sounds like a challenge, but I love the idea of finding those hidden opportunities. Where does the book suggest we start looking?
One area that often gets overlooked is business to business or B2B companies.
B2B companies. We talked about them a little before. What makes them such good investments?
Well, B2B companies sell to other businesses, and just like us, businesses need things and are always looking for solutions.
Right. And because businesses tend to be more loyal customers than individuals, B2B companies often have really strong relationships with their clients.
Exactly.
Yeah.
Businesses are more likely to stick with a provider they trust, especially if that provider is offering something they really need for their operations.
So when we're looking for those great companies with a lasting advantage, we shouldn't forget about the B2B world.
You got it. There's some real hidden gems out there, especially if you can find companies that provide essential services to lots of other businesses.
That's a great tip. It's definitely broadened my thinking about where to find investment opportunities. Now, I remember we talked about the margin of safety, but I'd love to dig a little deeper. It seems like a really important way to protect ourselves from risk.
You're absolutely right. The margin of safety is one of the key principles of value investing. It's all about accepting that we can't predict the future, for sure.
Right. It's about adding in some extra room for error just in case things don't go exactly as planned.
Exactly. And the great thing about the margin of safety is that it lets us make mistakes without losing everything. It's like a safety net for our investments.
I like that analogy. So how do we decide how much margin of safety to use? Is there a set percentage?
The book suggests about 15%, but it's not a hard rule. It depends on your comfort level with risk and the company you're looking at.
So if we're looking at a company in a more volatile industry or one that's newer to the game, we might want a bigger margin of safety, maybe 25% or even 30%.
Exactly. And if the company's been around forever and has a steady history, we might be okay with a smaller margin of safety, like 10% or 15%.
It's about finding that sweet spot between getting the most out of our investment and protecting ourselves from losing money.
You got it. The margin of safety is a powerful tool for value investors. It helps us make smart, careful choices. It's about knowing we can't see the future, but we can take steps to protect ourselves.
No, we've talked a lot about analyzing companies and the mechanics of investing, but Gone Fishing with Buffett also talks about the psychology of investing.
Right, like how our emotions can get in the way.
Exactly. Remember Mr. Market, that brilliant way of showing how irrational the stock market can be.
Oh yeah, Mr. Market reminds us that the market doesn't always make sense. It can be driven by fear, greed, all sorts of emotions.
So it's not just about numbers and financial statements, it's about understanding how emotions can affect the market.
You got it. And Gone Fishing with Buffett gives us some great advice on how to navigate that emotional roller coaster and make smarter choices.
It's easy to get caught up in the excitement or the fear, but as value investors, we need to stay calm and focused on the long game.
Exactly. And Gone Fishing with Buffett gives us the tools to do just that.
This deep dive into Gone Fishing with Buffett has been really amazing. The way it mixes practical investment advice with these deeper thoughts about life and success is so cool.
Yeah, I totally agree. It's not just about investing, it's about living a more thoughtful life.
So, listener, as we wrap this up, I'm curious what really stuck with you. Was there a business idea that got you thinking or a concept that changed your perspective?
I'd love to know too, did any of those analogies like the fishing net or Mr. Market help you understand those tricky ideas better?
I think those analogies are so helpful because they make these ideas easier to remember. It's like the author took these complex financial things and made them something we can all understand and use.
And speaking of using those ideas, I think the book's message about success is worth thinking about again.
Yeah.
It's so easy to get caught up in trying to make a lot of money, but Gone Fishing with Buffett reminds us that there's so much more to life than that.
It's about enjoying the journey, taking care of our relationships, and living a life that feels right and true to who we are.
Exactly. It's
Yeah.
about deciding what success means for you and not letting things like money or status define you.
And I think that's a really important message to remember as we navigate the world of investing and just life in general.
Absolutely. Real wealth is about living a life with purpose, meaning, and connection.
Couldn't have said it better myself. Well, that wraps up our deep dive into Gone Fishing with Buffett. We hope you enjoyed it and learned some valuable things along the way.
Remember, the key to successful investing and a fulfilling life is making smart choices, staying true to yourself, and never forgetting the big picture.
Happy fishing, everyone!